Okay, Nick Karadza, you're live.
Yeah, I'm just looking at you in their fancy new office.
Well, it's not.
Office
Yeah, we're not fully fancy yet. We are trying to get fancy in this place. We're changing the lighting.
Step
mood
one.
lighting. I brought you some mood lighting so that you can chat. So you can talk about the election policies in an appropriate mood lighting setup.
Well, yeah, I'm leaving. I'm not talking about that.
You just went to the Liberal website. It's down. But what were you going to try and? What were you going to talk about? The housing policy.
Well, I was just going to pull up their housing plan, but it's awesome that it's down. Liberal.ca. It says there has been a critical error on this website.
There's probably been a critical error with their policies. That's what it's what it's been. So like, what is?
But I swear, like I'm getting other sites. I'm just laughing. It's kind of funny. I'm like, they got to.
So they're going to start like a division to develop affordable housing, basically.
Yeah, but they can't even figure out how to do a website. Can you imagine what the division? That's the first thing when I saw that in their housing plan that they were going. I forget what it was called now. And they're going to start a new division to become kind of real estate developers. I was like, oh my God, that is the last thing that we need in this country is another government division. And then, I mean, anyone that understands the way the government's done stuff just has to laugh because you're like, those properties are going to be, they'll probably cost $2 million for like a 1-bedroom home. And it's going to take 10 years to develop anything because they're going to study it. I actually think it was in the document first. The first thing they were going to do is study about stuff because that's all they flip and do is study shit and they never actually get anything done, right? So anyways, it just seems like the stupidest idea ever. Instead of incentivizing kind of like the private sector, because it's so clear now that you can just see that the private sector can actually get things done with proper incentives and they can get things done in a proper way. It's not about making the private sector rich and doing all that type of stuff. It's just
providing incentives for the things that you want to happen in the economy and letting the private sector take over.
It's just a more efficient way to do it. Like it's not even close.
Well, anything that have you looked at just in healthcare, how many administrators there are in healthcare versus actual practitioners like nurses and doctors? Yeah. Like anything the government gets into. It's kind of ridiculous. Because I'm like, let's have affordable housing. It's totally perfect. Yes. Who wouldn't want affordable housing for the population you're in? Everybody wants affordable housing. Yeah. It's just the manner in which this is deployed. And then on top of that, the reason that we need affordable housing, it's a symptom to a greater problem that's never addressed. Like spend less money, government, than you pull in via taxes. Do you know what I mean? Like the whole reason you need affordable housing is because you devalue the currency because of the spending of the government is higher than the taxes you take in. But that's way too advanced for anyone to be talking about at the government level. So let's not even go there. But let's just provide the incentives for the government to incentivize the private sector.
Agreed. Build. Yeah. You know what was interesting? I saw this chart. So this was wawa.ca. I forget the guy that kind of runs it. Hanif, I think his name is. I forget the last name.
Yeah,
anyways,
I think it is.
So remember we put out that chart and we mapped out M2 to real estate prices like a while ago. So he did a version of that as well. And it looks very similar to
everybody's catching on to it.
But it's, and he's in the mortgage world because that site, I believe, is like a rate site for, where, it'll attract leads for mortgage leads and they kind of distribute the leads. That's the business model of that site. And so, but and he's kind of like, hey, look at this as well. So like some more people are looking at it that way too. So like some people's eyes are opening to it, which is great to see because it seems pretty, the correlation is so close that it's silly to ignore it, right? Even if you don't think like, well, I'm not sure if that's really the case, because there's an argument to be made like, which one comes first, really, right? Like, is the M2 growing because people are getting mortgages and that's increasing the money supply, or is it growing because of the government spending and then that increase in money supply is going to the assets? Like, which one's first? So there could be a conversation to be had, but we got to have the conversation.
Yeah, I kind of have thought about that a lot, and the way I always kind of come down to it would be that like the way money enters the system the easiest is. Because it's a debt-based system, it's wherever money enters the system with the most debt is where the money is coming in the fastest. So the real estate market, when anybody goes and gets a mortgage or a big juicy credit line on their house, that's a lot more debt coming into the system in the snap of the fingers than, buying French fries on your credit card. So it comes in through the avenues that just create the most debt the fastest. So the government, through deficit spending, creates a lot of debt. If the foreigners don't buy the debt we need to fund that deficit, then we're just kind of printing that through some central bank and bank magic wand action. And then through the real estate market, a lot of debt is created. So it's coming in. It's kind of like you're incentivized to go get a lot of debt by the banks to get real estate. And that incentive creates a lot more debt. Yeah. If that makes sense.
Yeah, there's different levels. So there's different culprits, right? Government spending's the largest culprit, and then there can be other ones as well. But yeah, I mean, I think it seems pretty clear now. And then if you look at what's happened more recently, just in the real estate market, so prices have come down in certain areas, different prices have come down at different rates depending on the area and the type of property and things like that. But what's also been happening at the same time is they've been trying to remove money from the system as well. So money supply recently has been dropping, and then that kind of brings other things down.
Yeah, it's just such when you think of it. Here, I'm just going to put this chart up. Let me see if I can move this to this for a second. I'll put it on the screen. This is the M2 money supply you're talking about. That's it. So for anybody watching, you can see. For anyone listening, it's Canada's M2 money supply compounding at a growth rate from 19. So I think I took this data from 1973. Yeah, from 73. 1973 to 2025, 8.77% compounded annually. 8.77%.
Well, just call it 9.
Let's 9%. 9%. That's how much your currency is losing value every year. And it's just such a convoluted thing for people to understand. I get why nobody really cares about that kind of stat, because when you're living your life, what do you you're not paying attention to the M2 money supply, but you kind of want to tell the population, hey, listen, if you don't grow your net worth or your income 9% a year compounded every single year, without fail, you are falling behind.
Yeah. The crazy thing is when you map that to stock market gains, in the index, because most people now, because of low fees and stuff, I feel like the majority of people, I mean, I'm no stock expert, but the majority of people probably invest in the index. I think, if you look at the assets under management of the index funds, they're just enormous, right? And if you look at the growth, it's kind of about the same. And then it makes you wonder, it's are you really getting
we're like a zombie economy.
Yeah. Are you really getting ahead with that? Because, serving a purpose is kind of, it's kind of keep.
You're not losing. You're not losing.
Yeah, exactly. But you're not getting.
Well, it's like unleveraged real estate. Unleveraged real estate is going up about the same rate, just as you're saying when you mapped it against the chart. So if you have no leverage on your real estate, are you really getting ahead when your real estate prices go up? Kind of not really. You're just keeping up with the debasement rate without the leverage on the properties. Which sounds horrible to say because you don't want everybody max leveraging everything all the time. That's when you get into trouble. But without the leverage, are you getting ahead? And so when you own a piece of real estate, as it's paid off and you've invested more and more to pay off that mortgage and you lose the leverage over time. So on a 25-year term, when you're 15, 20, 22 years into that 25-year term, you're kind of losing the initial leverage that you had when you just had 20% down on the property. Those first few years are really when you're at max leverage. Yeah. Because over 20 years, you're investing a lot more into the property with the payments.
Yeah. And then what's happening, I guess, is because your payment remains the same, well, roughly the same, call it the same, when you renew after 5 years, whatever. Yeah. But later on, you're not getting the benefit of that increase in cash flow yet. But then all of a sudden there's a switch, because if the property gets paid off, and I don't know the numbers.
Then you go to full cash flow.
Yeah, because then all of a sudden if it's spitting off whatever the number is a month, then you're getting the benefit of the increase, and then you're getting that cash flow.
Well, you're getting the 7% compounded historic growth of real estate and the cash flow.
Yeah. So then
the property's making you not fall behind kind of in purchasing power, because it's matching M2 kind of sorta close.
But you got a lot of equity tied up there, because if the property, call it let's just use a round number of $1 million, you have $1 million sitting there. So it's still growing at 7%, long-term compounded.
But then the question is the highest and best use of the property unleveraged like that?
Yeah, that's what you got to wonder. But Yeah, I don't know, because you could leverage that. You could use that $1 million to do. Yeah, there's opportunity cost.
And I guess it depends on your personal situation too, because if you're, in your 60s, you're like, I don't want to deal with the leverage. The cash flow is all I need. I have some other assets and I don't really need that much more. But if you're in your 30s and you're in that situation by chance, by some miracle, you have this property that's paid off. I know that sounds ridiculous to even say right now, but then it's like, yeah, wouldn't you be smart to refinance, pull out some of that equity?
I don't know, man. There's an argument to be made both ways, because if you, let's say it spits off, a property of that.
Well, a student rental. That's what I'm saying. A student rental is going to spit off like $4,000 a month.
No, it's going to spit off more than that.
Sure, more. I'm
right now. No, but it's like $9,000 a month, right? If you're looking at some of them at that point.
A seven bedroom?
At that price point, that's what you're getting.
Okay, let's take off some taxes, some maintenance.
Okay, so you're getting about $1,200 a month, right? So that's
per room, you're saying?
Sorry, yeah, per room, times 7. So you're like $9,000 or so, right?
I don't know any 7 bedrooms getting $1,200. Most of them are 5 around Western, but yeah, I see your point. Yeah.
Okay.
Yeah. Most of the 7.
Okay. So take expenses away. I'm just trying to think. So let's say that thing's spitting off in free cash flow after some taxes and stuff like that. What is it? 50, 60 grand?
Mm-hmm. Yeah. Yeah.
Right? I'm like, okay. So that's a nice little that kind of
$5,000 a month. Yeah. Yes.
So that gets kind of.
But you're still not
it's only 5 or 6%, but then you're getting the 7% on top of that. So
but how much is that property worth?
Well, we said $1 million.
Okay, so I'm saying refinance some of that, take 20% of that property, buy another property. You're way better off.
Oh, yeah.
You're way better off. You're just not maximizing.
If you're taking 20% out, if you're not going back up to 80%, because then you don't have the same amount of cash flow again. So you got to wait that period of time.
Sure, but take 20% out, buy another property, you're back getting the leverage on the real estate.
There's different stages in life, like we've talked about before.
Yeah,
right? Because when you're 60, maybe you're like, okay, cool. Like if I have 3 of these properties, I'm comfortable letting one spit off 50, 60 grand for me, because in my retirement, that income stream is great.
Mm-hmm.
And I'm just like, I'm going to sit on that income stream's great. Like that's what I want. Mm-hmm. But when I'm 30, maybe I'm, and I'm working full time and stuff, maybe I'm not looking for that and I'm earlier in the journey and these things are leveraged further. So they haven't been paid off yet because the time hasn't gone by to pay them back.
I'm just trying to play devil's advocate. Like, why would I not want to do that? I guess the only reason I wouldn't want to do that is if the cash flow from that property is constrained so much by rent controls. And if inflation in the area I'm in Ontario, let's say, rips, then maybe the cash flow in and of itself is like, not that big of a deal anymore. I'm just really trying to go to the extreme example.
Yeah, that's extreme.
And then I know that's an extreme example, but that would be the situation where you're really not winning by having a fully paid off property.
No, but then in that case, you could refinance at any point.
You could refinance.
So you're like, okay, well,
you would have the option.
Circumstances have changed. You could do it at that time, right?
Unless you're completely retired. Sorry, again, I'm just going to.
Yeah, but loan to value, even retired, it's pretty easy. Like if I
can take 20% out,
20, 50.
I don't think I've asked that question to mortgage brokers before, have we?
Well, it depends. You can even go to B lenders and private. I mean, there's all sorts. There's options. I mean, depending equity, loan to value. Yeah. If you're talking $1 million property, you own no money on it. Mm-hmm. You'll be able to get funds.
Mm-hmm. Jeez.
It just gives you options.
It gives you options. That's the nice thing about real estate. It's a freaking pain in the ass, but it gives you options.
I think and it gives you a few more options than other things.
Because you're controlling. How we talk about in the Bitcoin world, we talk about custody, but real estate to me is the closest traditional financial asset where you have more custody than anything else, a treasury, a bond of any sort, a GIC that you're investing in, a stock, anything in the financial system can be let's face it, if Trump comes out next week and announces something crazy and the financial system just flips upside down, the banks are just going to freeze for 5 days until they figure out what's going on. Then your Apple shares that are in your TD or RBC online account, do you really have access to that asset? At least with the real estate, it's in your name. It's a physical thing outside the system. The tenants pay you directly the income on that property. So to me, it's the closest traditional or regular asset that you have the most custody over.
Other than gold or silver, like precious metals.
Monetary type stuff. Yeah, sure. Gold or silver. Yeah.
But it's harder to leverage against that. Like there's less options. But then again, I mean, we can go down this rabbit hole all day long because then now you need the banks though to leverage against the real estate. Mm-hmm. So, But yeah, I mean, it served us well. So I guess we were biased towards it. I mean, like, you know.
No, well, I think we're just having these conversations because now we've owned it, real estate, for so long that we're coming to the point on some properties where you're like, the mortgages are like getting to the end of their amortization periods, even after we've refinanced some properties.
Yeah.
So we're looking at possible cash flow numbers that we've never really looked at before. We've never really looked at that and said, holy crap.
No, it's just been about acquiring them and managing them and, like, you know, and you
suffering through it, but having the benefit of having these assets.
Well, you're seeing the equity increase too.
Yeah.
There's the cash flow component, but then now it's just, the numbers are changing. So it's like, okay, so where do we go with these? I guess the conversation is more like, okay, where do we go? At this stage, like, how do we want to kind of move forward with this?
And I don't think we really never expected real estate to go from the great financial crisis on steroids the way it did, which brings me back to this election, because the Bank of Canada governor that was reducing rates that really made real estate unaffordable is Mark Carney. He's the same guy who's now here saying, oh, you know what? Real estate's unaffordable. I'm here to save the day. Here's a new program.
Yeah.
Like, have you ever just thought about the irony in this? He's the Bank of Canada governor that dropped interest rates during the great financial crisis to save the banking system. That then proceeded to make the real estate market unaffordable for the majority of Canadians. And the same guy is now here saying, elect me because housing is unaffordable and I'm going to fix it. And again, anyone listening to this, I don't care about any individual politician. This is not an attack on Mark Carney. I'm just talking about the facts of the guy who reduced the rates is now back saying, hey, housing is unaffordable. I'm here to save the day. Like, you can't make this up. I think we might be living in a simulation.
No, it's an attack on Mark Carney. Because he's the guy that did it. It can be an attack on Mark Carney.
But I mean, there are many other central bankers and politicians around the world who've done similar things.
We can attack them as well.
Yeah, I don't mean it just directed at this guy. I could honestly care less.
Yeah, I don't care who it is. And I don't care if he's liberal, conservative, or anything. It doesn't care. But it's just that facts are facts.
It's ridiculous.
Yeah.
And sometimes I look around like, are we the only ones paying attention to this? And I guess now we're a bit older, so we have the context of the great financial crisis. Because let's face it, if you're 30 right now, the great financial crisis was 2008. What's 17 years ago? So you don't even you were like
realize.
What are you, 12, 13 years old? That's another world.
Yeah,
doesn't even matter. You know, even if you're 40 now, the great financial crisis,
you were early 20s.
Early 20s. So then you don't even know what these guys did. So let me set the record straight here. Actually, I want to take this opportunity. These central bankers that were in power during the great financial crisis, in order to save the U.S. banking system, central bankers around the world simultaneously dropped interest rates to the floor. What that did in Canada, which focuses on the real estate market to a great extent, much more than the stock market here, we monetize the real estate market. What that did to the Canadian real estate market, prices went like this. You could buy a single detached home in Burlington, Ontario for like $250,000 before that happened, which sounds ludicrous. Nick, we had investors buying. I worked with an investor, a 265 fully detached home in Burlington at like 2009, 2010.
Really?
Yes.
Detached?
Fully detached.
I'm trying to think of
North Burlington. Yes.
Yeah. Okay.
Yes. It wasn't prevalent everywhere, but okay, let's just move over one city, Hamilton.
Yeah, no,
fully detached home in 2009 and 10, $210,000, 3-bedroom, fully detached, 60-foot lot, like 130 deep, driveway along the side, beautiful home on the Hamilton Mountain. That home now that was $210,000 is on the like West Mountain now, $1 million. $1 million. So 5 times since that. So the people that dropped the interest rates caused all of this to happen. And now people are looking at these people to save the day again. That's just what gets so ridiculous about politics. And it's why, if you're going to like try to have some self-sovereignty, you need to just take ownership of your own finances, figure out how this works, because you're getting gaslit to the max.
Real estate investing isn't always easy, but it can be relatively simple. And that's where the Rockstar Inner Circle comes in. Look, there's a lot of real estate investing information out there these days. That's why it's so important to pick your sources wisely. And even though investing isn't always going to be the easiest process, it does not have to be super complicated. That's where tried, tested, and proven strategies like the ones that Rockstar members use come into play. Everything shared in the inner circle is built from firsthand on the streets experience in the current market. It's all up to date, things that people are actually implementing today. In fact, the ongoing courses are delivered live, so they're always up to date with the absolute latest real life experiences. As a Rockstar member, get ongoing access to over 20 different systems and programs covering things like which properties investors like and why, our private rental system, what opportunities the investors are scooping up in student housing currently, the legal side of investing, why or how to use corporations as an investor, a mortgage class with the absolute latest options and programs to build your portfolio as an investor, because they're different than a regular home buyer. And there's a whole ton more in all those different classes. Of course, to implement all these strategies, members get access to unlimited private one-on-one coaching with an actual human experienced investor, not an AI chatbot, not ChatGPT or anything like that. It goes beyond training, classes, and real estate. It's a community for people looking to take control of their own finances, to give themselves options and allow them to live life on their terms. With ongoing live and virtual opportunities to connect, it's built for investors by investors. You can see everything members get at rockstarinnercircle.com/member. It's rockstarinnercircle.com/member. Now back to the show.
No, but you're 100% right. It's been pretty bad.
I want to move to the real. Oh, I don't know what you were going to say.
Well, no,
your expectations of the real estate market going forward now.
Yeah, so we'll come to that in a second. But here's something that, like, when you're talking about this, the current kind of situation and gaslighting is, if you look at the carbon tax is the best example. Like, these guys put the carbon tax on, right? And they told us for years that 80% of people are better off because of it. And then
then it wasn't raising prices on anything.
Yeah. And then they take it off.
And they're celebrating the price, like, gas prices.
So, like, which one was it? Like, are you now ripping us off, or were you ripping us off before?
Make this up.
And then if you do the math, even on like an average tank of gas, I think around here, gas prices dropped by like 20 cents, right? Just do your math on how much gas do you use and the rebate check you were getting. You're like, you were getting ripped off, not to mention all the other costs that it was increasing. Like, I mean, it's so stupid that, and then people like believe it. They're like, yeah, no, they're doing a good thing. I'm like, are you flipping crazy? I think I saw someone say, like, I think I saw someone mention, like, it's like if someone's punching you in the face and then they stop and you're like, hey, thanks. Thank you. You stopped. That was a great job.
You're amazing.
You're
what a great person.
But I just want to talk about something, because this gets me. This is like just a little bit nuts. From 2015 to 2021, there was a chart, and I had the guy that posted it. I has his name, so I forget it. But it's the Canadian growth, the real GDP per capita growth in Canada. Okay, over that 10-year period, Canada was, out of OECD countries, we were number two to Luxembourg. Our growth was 1.4%. Luxembourg was negative 0.9%. We were number two. The top numbers are like 41%.
I'm going to put the chart up on the screen.
Oh, okay, you got that?
There we go.
Yeah. The top numbers are like 40%, 39, 35. Like, the US is 18%. We were 1.4. Okay, during this period of this government, and I don't care. This isn't a liberal conservative thing. I don't care. This is just the government that was in power.
Like, we're other than Luxembourg.
Yeah,
it's Canada, and you're right. How many countries are above us there? 20, 25, 30?
Yeah, it's
whatever it is.
It's a joke. Right. So then I'm like, but people are just kind of ignoring that fact. And, people are looking around and they're like, yeah, well, no, things aren't so bad. And this is what's interesting about this current election is in the Canadian history that I've seen and I've read about, there's never been such a divide in the polling numbers between older people and younger people.
I know.
So what's happening with, and I'm just trying to pull them up here. I have them from like a week ago or so. But what you're seeing with these polling numbers is that, oh, here it is, 60 plus. You can see that this poll that I have from the end of March, and I mean, the numbers are all over the place, but this poll, and most of them are showing that, generally older Canadians, so boomers. So like in this one, 60 plus, it's 50% liberal, 29% conservative, then 50 to 59 is kind of close. And then the rest of them below 50 is pretty much conservatives, are kind of leading along the way. And you've talked about this before, younger people in Canada are so frustrated because they've seen the last 10 years and they're like, look, this is shit. We're in a shit situation. We can't afford housing. But then the older people in Canada,
have assets that have inflated up.
Exactly. And it's the exact conversation that I had with Doug, I think it's Hoyes is the way he says his last name, who deals with a lot of people that are claiming bankruptcies. And he's a bankruptcy trustee. And he's like, look, there's basically, from what we're seeing, there's two economies in Canada. There's the economy of people with assets and ones without. And so the people with assets are looking around, they're like, yeah, well, things aren't as good as they used to be. You know, things are more expensive, but they have assets. So they're like, it's not so bad.
Not so bad.
But the people without the assets,
a lot of equity.
They're like, this is shit. Like, we got to fix something. I can't afford a house. I can't do this. And this is like the divide of Canada. This is kind of what we were talking about before. It's the destruction of the middle class. Right? And we've been talking about this. We've been kind of screaming about this.
We wrote a report on it, I think, in 2015.
Yeah, we've been kind of screaming about this, and you're kind of seeing it come to fruition now. And it feels like that a lot of not all of them, but a lot of older Canadians don't have empathy of the situation of the younger Canadians, because they're just like, well, it was harder for us too. Like, don't buy the latte and everything's going to be okay. And it's like, no, it's not the same situation anymore, and something has to change. But there's no empathy from the older people looking at the younger people and truly understanding that. And when I talk to our parents as well, when I talked to our mom, she kind of was like, yeah, really? So things are like, I don't get it. Like, they're not that bad. You know, when then I explained to her some certain situations, like,
income relative to
as a 20-year-old coming out of school, how different it is. Yeah. She's like, I never really thought about it like that. And there's a gap, and that's what I think is really kind of, just driving this divide that we're seeing right now. And I don't know, like, it'll be interesting to see where it goes. And the last thing that I'll mention on this point, what's super interesting, is that the majority of people that, if you call them boomers, or you call them 60 plus, whatever it is, but the majority of people of that kind of generation, they're getting their information in their media still from these traditional media sources. If you look at these, these cable news networks, like, the CBC, CTV, things like that, whereas the younger generation,
state-owned media.
Yeah. But the younger ones, they're getting they're like, no one watches cable TV anymore.
No.
So they're getting it from all other sources. Yeah. And some people are going to say, well, that might not be a good information, but you know what? A lot of the information they're getting from those different places, even if it's Instagram, TikTok, things like that, it's actually more good information.
Yeah.
And they can decipher the information themselves, and they can make the decisions they want to, and not just one point of view. So it's really interesting to see where this is going. And the reason why this matters so much right now is because it's going to matter in the real estate market. From an investor standpoint, it's going to matter in the real estate market, and just from a home ownership and like economic point of view and growth point of view for Canada, it's going to matter. And if you're an investor, you want to understand what's going to happen in the country, because if you're taking your resources, you want to then invest your resources where they can do the most good for you. And if there's not growth in the country, then you're like, well, why am I going to take my resources and invest?
Which we saw happen in Croatia.
Yeah, they're not going to invest in that country because there's more growth elsewhere.
They will leave the country.
Exactly.
Your youth.
Yeah.
Your educated youth, hardworking youth.
But people don't see this happening, and it's happening right before our eyes in Canada. Something has to change.
I don't really think anything's going to change.
People have to wake that slip up, man. No, but because it's happening. Like, look, we've been talking about this for how long, and you can see it. It's like this slow-moving train wreck, right? And
it's like a car spinning out of control on black ice, but hasn't hit the guardrail yet.
100%.
You know we're spinning out of control, but the big crash has not happened.
But the thing is, not everyone sees the. Everyone's like, no, I think it's okay. I think.
Well, people are paying their bills and struggling to just get through the day.
Look 5 years ago what it was like, and look 10 years ago, it was better.
But what do you really want people to do? They can vote differently. I guess if you don't like the last 10 years, vote differently. There's that. But like other than that, and then the system.
Well, at this time, yeah.
So that's the obvious.
Right now, the next thing you can do in 30 days is, first of all, vote. Get out and actually vote, and then think about who you're voting for. Like, look up some information. Don't just talk to like one person and say they're voting for this.
Before you vote, look up some information.
Yeah. Do you want the government in control of building houses? How do you think that's going to go? Look at everything else they're in control of. It's shit. So you want them in control of building houses, or you want something else, right? I mean, look, I'm not saying any politician's perfect, and but I mean, if we've basically been driven into the ground by the people that are in power now, so I mean, you got to take that into consideration, no?
I mean, if we just had a government that came in and like built some pipeline, instead of competing around the world on stuff that maybe
virtue signaling BS.
Yeah, like maybe we could just, we have energy, the world needs energy. why don't we just kind of sell the world what it needs
and wants
and what we have,
and knocks on our door asking for it. It's crazy. It's like if you have a business in like a local plaza and you're selling whatever you're selling. Let's call it these, cupcakes, and people are like knocking on the door saying, "Hey, these are really good. Can you sell me cupcakes?"
Yeah.
No,
I got these granola bars. You want these granola bars?
Yeah, it just is like.
Yeah, but I mean, I guess that I just don't have 100% confidence that whoever you vote in, anything changes really. But I'd like to see a change.
No,
I'd like to see a change. I'd like to see an attempt.
Yeah, 100%.
Yeah.
Look, it's politics. We've all seen many situations where people will say one thing and they can't execute. And to really execute certain things, there's always headwinds. It's like no matter what you do in politics, no matter what the party is, whatever you want to try to do, the other party's saying it's bad. Even if under normal times they would agree, because they just have to disagree with you and say it's bad to make you look bad with the hope that they get in power, stay in power, or get in power next time. Like it's just a stupid game, right? But I mean, so you need a strong leader that's willing just to kind of overtake that. I don't know if that anyone that's running right now for us is that or not. So there's take that into account. I'm not just. Yeah, I'm not saying how to vote. I'm just saying.
Well, just the frustrations there. Like we never used to talk about any sort of politics really much at all because it was just so clear. Hey, buy these assets, do this to get ahead. But then when you see the country go on a certain path for so long, you kind of get a little frustrated. You're like, okay, listen,
the hell up.
Yeah, we got to make some different decisions. But then you kind of go to the system itself, and it's like, oh, geez, can like really anything change? Because underlying the government is the base monetary system, and the base monetary system is debt based, which means more borrowing has to continue to happen no matter what, or the system itself collapses. So then it's like,
can we U-turn? Maybe not, but can we kind of go on a path that isn't straight down the hill? Like
we can make things better for sure.
But on that note, so these the tariff stuff, because it kind of plays into that right now, because I think that and I think you agree that there's a bigger game going on with these tariffs than just like let's get these other countries and we don't like them, and maybe we're wrong, but I mean,
I think the bigger exactly,
because I'll give you the stats I saw this morning. Here it is. I just so this is recorded shortly after the tariffs were put in place, and the 10-year yield is down 90 basis points, so almost a full point. The 10-year yield, and oil prices are down 25%, which I kind of think is like, that's kind of what they were, part of what they were after, that no one's really talking about.
Yeah, they want to kind of crash the system a little bit so they can come in and reliquefy it,
I think so, and reliquefy at a lower rate than they.
So there's so much to talk about on this point, but I think the big thing is that I think this administration in the U.S. is just faced with the realization that all this debt they have $9 trillion out of the $36 trillion that has to be refinanced this year. And if interest on the debt is already at like an annualized rate of 1.2 or 1.4 trillion or whatever it is, and you have 9 trillion that was financed at slightly lower rates, you really kind of have to bring rates down to make this a sustainable situation. So they have to bring rates lower. So there's that seems to be happening. And Scott Bessent, the new Secretary of the Treasury in the U.S., has kind of basically said that he wants rates low. He said in multiple interviews he wants the 10-year rate lower. But then there's also this other thing that I think this administration's just been left holding the bag a little bit. I'm not really defending anyone, but the whole system's broken. So you can't have the U.S. dollar acting as the U.S. reserve asset in the world anymore, because it's created so much deficit spending and so much inflation, because you need to send dollars out into the rest of the world, because those people around the world need those dollars because they want them on their balance sheet as the world reserve asset. It's the best thing. But then when all the dollars leave America and you're running these trade deficits for so long, you lose jobs, you lose factories, and now you're running the risk of losing the confidence in the dollar itself. So they're basically saying, okay, up go the tariffs, bring the factories back in, bring the jobs back in, the whole globalization and the whole thing with the US dollar being the world reserve currency, or reserve asset. We think that game's likely over. We don't want to speak those words, but you can see by their actions.
Well, they can't do it because otherwise that changes things very quickly. And it gets disorderly.
Yeah. So that's what's happening. Put up the tariffs, try to get jobs back in, try to get factories back in, and it leaves countries around the world like Canada looking at itself and saying, holy smoke, can we compete in sectors where tariffs are now up? and it makes for wild gyrations and wild economic uncertainty in countries like Canada, other countries around the world, of course, too. Like, I don't know if you saw, I think it's Vietnam or Thailand. Was it Vietnam or which country? Thailand? I forget what country's already at the door of the U.S. saying, okay, let's negotiate these tariffs. Argentina's already at the door of the U.S. saying, let's negotiate these tariffs. So it's like all countries around the world. And Canada, I think, has to look itself in the mirror and say, hey, are we going to compete in these industries that maybe we had an advantage on because our currency was weaker than the US dollar? Or do we have to reallocate incentives back to what we were saying, to sell the world stuff that we have and that we're good at?
And we have so many raw materials.
We have so much. We're so rich. Yeah. And Canada's like the greatest country ever. We have so much. We have so much energy. We have so much lumber. We have so much raw minerals. We have gold in the ground. We have fresh water. We have hydroelectric power. At one point, we were the leader in nuclear energy production. We probably still have that intelligence here in the country. So like we have.
We were the leader in nuclear. I didn't know that.
But I remember being in grade school when those nuclear plants went up, and there was like all this talk how Canada was like setting the bar on the nuclear stuff. And then we just stopped doing nuclear. I don't know if we have that intelligence in the country anymore, but for a while we were like a big deal. And then we have 2 oceans, actually 3. We have the Arctic. We have the Arctic Sea at the north. No, we have the 2. So we have all this access, these access points. Like we are the richest, most beautiful. Everyone in this country should be rich. Everybody in this country should be getting direct deposits from the government from how much money we are making from selling the world all this beautiful stuff that we have in such plentiful quantities. But then we don't do like the most obvious thing. Like when you hear that we have like oil on the east side of Newfoundland in the water there or whatever, and we could use a pipeline to bring it into the rest of the country, but then a province like Quebec is just saying, sorry, no pipelines. I mean, what are we doing? Like, why are we not building a pipeline? I don't get it. But then you have other countries building pipelines, and then we just stand still. And it's like...
Well, our pipeline, like right now, the way we transport from the west over to the eastern parts of Canada is actually through the U.S.
Through the U.S.,
Like it goes down.
Yeah.
It goes down.
Because I think you have to mix our heavy crude or whatever it is with their light, and it mixes in a refinery. They need our crude, and then we mix it down there. So like we need refineries here too.
But the refineries are further south. That's what they do with that. This is if we're just bringing the oil directly over or the gas.
I'm so uneducated. I don't know if we can bring it directly over and use it. We need a refinery here.
Even for the LNG?
Oh, the LNG might be different. Yeah.
Right.
Yeah,
for the oil,
liquid natural gas might be different. Sure. Yes.
And I thought that's what I'm talking about that we're using.
We need to find an absolute expert on this.
That would be great.
Bring them in. That would be fantastic.
Yeah. Yeah, there's someone, you know what, Pierre, Paul, there's someone knows someone in Alberta that understands this.
If we could bring somebody on, if anyone listening to this knows somebody in this space, we need to have them on to set the record straight completely on this. Because it just seems ridiculous, because you're right, those pipelines from Alberta, they go down into the States.
Yeah, and then they run through the northern part of the States and
they connect
up
into
through
Ontario here.
Yeah.
So if we turn off to America, then we don't get the Ontario access. It gets cut off as well. Like it's completely, and then now just on the ludicrous front, then we still have tax barriers. Like everyone in Canada is freaking out about these tariffs, but we have taxes and tariffs between provinces.
Oh, I know. It's a lot.
So like the whole thing is just kind of nonsense.
We've done nothing about it since they started doing this. Anyways,
we're not solving that.
Yeah,
we're not solving that today.
But to your point about the what's happening with the debt, tariffs, currency, the U.S. dollar as the global reserve currency, it's why you're starting to see things like gold, which is like a neutral asset. You're starting, like what's happened with gold in the last year? The price is up 50% or more, and a lot of that gold is now being onshored back from Europe into America too, because you're seeing that happen too. So you're seeing these trends change. Mm-hmm. So some people are looking at what you're talking about and saying, okay, well, here's the challenges with keeping the U.S. dollar or
America announced a strategic Bitcoin reserve.
Yeah.
Think about that.
So they're looking for neutral reserve assets, and it's why you're starting to see that type of stuff. So like if you're an investor in this case, or if you're anyone and you're just trying to understand like, hey, so how do I kind of protect myself during this? It's like if you see these big trends happening at that level, then you have to start considering those trends for yourself as well. You can take advantage of those same trends on a smaller scale, and you can benefit from them the same way, mm-hmm. right? So to your point about like holding assets, like we were talking about earlier, well, if you hold the asset like gold, you're now benefiting from that trend as this mm-hmm. continues.
And there are more ways through technology. I mean, Steve Jager is going to be out at the event, but Addy allows people to get into hard assets in real estate $100 at a time, $1,000 at a time. They go as low as $1 at a time. I'm not saying that maybe that's not everyone's preference to get into real estate that way, but with technology in some of these spaces,
it's an option.
It opens up access to hard assets that you might be saying, well, how am I going to buy a piece of real estate, guys? Well, you can get hard asset exposure that way too. Mm-hmm. So there are new kind of options. And I think that's the thing. Like if you just know they're going to keep printing money and the debt's going to go higher and higher and higher, you just want to have hard asset exposure, whatever your hard asset of preference is. So what is going, I think the biggest question we're asked right now is, where do you see the real estate market like 6 months and a year from now? Like, because in the last 15 years, we just had booming real estate. Like maybe there was a tiny hiccup in 2017 a little bit, but from 2008 to basically 2023, the market just like went one way, rocket fuel forward and up, higher right. So now in the next 6 months or year, because I know in the medium and longer term, we just know because the dollar is going to get cheapened and debased, the dollar price of real estate is likely going to be higher than it is today. But what about in the short term? Like what about in the next 6 months and 18 months, activity wise, price wise?
I think it's relatively flat. And I think that's kind of a healthy thing. The way it went up and to the right that fast is never good for any market. Things that kind of go up like that it's not sustainable, which is what we're seeing.
And look at the angst it produced in the communities.
Totally. Right? It's just not good. So if we get back to that which the historical number is outrageous when you think about it. It's like roughly 7% around this area, different slightly changes, different areas, different assets. But like if it gets back to that steady rate like that over the long term, it's so good from an investment standpoint. Like, and I'm talking real investor, not speculation. I'm talking someone that's buying a productive asset and managing productive assets. You're able to plan. You're able to invest for the long term and understand and look at numbers and plan accordingly. If you buy a building, you're like, okay, so I understand here's roughly where the numbers are going to be. It's a relatively stable market, so I can plan accordingly. When people leave and I turn these units over, I can do the renovation. Here's where the rent should be. You can make a business plan out of that. Whereas when the market's so distorted that you can't really plan it.
We knew people flipping properties that bought the property before they started the renovations. It went up so much they just sold it.
Yeah,
they were flipping properties without doing any work.
You just knew that was totally unsustainable. So I think it's going to be kind of relatively flat, but I think there's going to be a big discrepancy between, and we've talked about it before, the condo market in Toronto and elsewhere, specifically Toronto, and maybe like the low rise market in and around the city. Because what you're seeing is the numbers of the new units coming on for those condos are very high. The number of new units coming on for single family housing or detached low rise housing is very low and trending lower. And demand for those things hasn't really changed. Affordability is an issue, and affordability is going to continue to be an issue. But the demand, the vast majority of people that live in a 1 bedroom or 2 bedroom condo, they would happily move to a low rise home. There are some people that prefer high rise living, and that's fine. But the majority would happily, if it was all things being equal, they would say, okay, sure, I'll take the house, right? So the demand that people actually want to be there isn't going to change, and with the supply just not really there, and it looks like unlikely to really change anytime soon, especially anytime soon, because there's no pre-sales and construction happening, so that nothing's really getting built. That we're not going to that segment of the market. I think we're going to be in a surprise in a couple of years when people are like, oh, but there's really not enough of these around, and people want them again as the economy has stabilized. Maybe even later this year, you start seeing earlier signs of life in that segment than other segments of the market. So, I think we just need economic stability right now. And I think this tariff stuff that's happening with the economy, and the job numbers just came out today, and the job numbers are they weren't too good. Right? I don't know if you saw that yet or not.
I didn't.
So the Canadian job numbers weren't good. They missed. There's job losses. Unemployment's ticked up a little bit or whatever. Big surprise.
Which we've been talking to people for months now. We know that's the case.
So once that kind of a little bit of stability is there, and I don't know when that stability comes. Is it later this year? Is it next year? Whatever. I think then you start seeing a shift in things, because there's a lot of people that are quite, from the conversations we're having, investors and just homeowners for their own personal uses, they're sticking their heads out and they're like, yeah,
but they're sitting on their hands because of all the confusion.
Exactly. That's exactly what's going on.
Mm-hmm. So as soon as the elections pass, there's a bit more clarity. Maybe this tariff stuff gets settled in that, like, maybe there still are tariffs, but like everybody knows what they are. They're kind of permanently set, or at least set for the short, medium term instead of changing daily or whatever's going on right now.
Yeah, then you can make decisions.
Yeah.
It's no different than when we were talking about before, when the market was ripping, when the numbers are getting skewed. So every month something changes, there's a new tariff, whatever. You just can't plan accordingly.
Well, any business owner is just looking around right now saying, how do I plan any expansion? How do I plan any hires? Like, I don't know what are interest rates going to be? What is the economy going to look like? You just can't do it.
Yeah.
And with Canada, I guess I'm going to put this chart up here. Here, I'll put this one up just for a second. This is Canada's gross debt, government debt to GDP. And in the 90s, because a lot of people online are saying, well, in the 90s, the debt to GDP was like around 70. I think it's between 70 and 75%. And then it started kind of ripping higher. And in the 90s, that was a tough real estate market for like 6 years. Prices ground down from like 1990 to 96. And I think some people are wondering if we're at the same spot. And I guess the one data point that interests me is that if you see on this chart, the current debt to GDP in this country is almost 110%. And throughout history, all the economic history that I've ever read or been able to research, there's never been an economy where debt to GDP has gone over 100% and the solution by the government wasn't to inflate it away. So I can't see a period of 6 years, and this is dangerous to say because I don't have a crystal ball, where prices just keep grinding lower when you have that much debt. Like the government, because if the population gets so tight, when prices grind down, it means, your credit line access is lower, the equity in everybody's real estate is lower. Do you have enough liquid cash available in the population to pay for all the debt? And if you don't, the whole system collapses. So when I see debt to GDP at 110% or so, I think they're going to have to just lower rates maybe a little bit more, or have other programs, or have some access to liquid money, save a sector of the economy, save whatever sector of the economy you want to name, and throw in billions of dollars just to flush some liquid money into the economy, because you just can't have this slow grind when debt to GDP is at this level. And throughout history, I've never seen a government not inflate the problem away when debt has crossed over 100%. This is some old James Rickards data that we saw in those books. There's never been one. So I don't know.
Yeah, when I was talking to Sean in here, we were having the discussion between deflation and inflation, and he was saying that the economy to function properly needs inflation. He's not, he's like, you can't have both, deflation or inflation, take your pick. And
well, you can't have both because it's a debt-based Ponzi scheme monetary system. That's why.
Yeah.
And that's what somebody like Sean is a brilliant guy. We love Sean.
Oh yeah.
But yeah, that's what he kind of misses, is that like it's just mathematically doesn't work.
Well, he's saying for his point, and we went back and forth, so I'm not attacking him at all. It's just his point was like, then people are just going to hoard their money. Mm-hmm. Right. And then you're not going to have which is like the economic activity that you want if people are like, well, the prices are just going to come down. Mm-hmm.
Which is the Keynesian answer to that statement. But it's like people still want to live their lives. Mm-hmm. So it doesn't matter. You eventually want something. And you spend your money on that thing.
Yeah, I brought it down to value, and like if you can provide enough value for me today,
sure.
Like I think I use it. Well, if I bought a new house and I needed kitchen dishes, I'm not going to wait 6 months to have dishes in the house. I'm going to buy them today. Yeah. But that wasn't the point. But what I'm saying, where I was going with that was that, the economy is structured in such a way that they're always looking at inflation. They always want that inflation because the belief is that you need that inflation. So
it's funny because they're partly right in this system. They are correct. You do need the inflation. Otherwise, the system collapses. Mm-hmm. However, we aren't running a real economy on real economics. We are running a debt-based system on a debt-based money. So therefore, you need the inflation. Otherwise, the debt-based monetary system collapses. Mm-hmm. So it's kind of like they're right and wrong all at the same time. To keep the system going, you need the inflation. Should we have a system that requires inflation, silent theft, thievery, and robbery from the population? Fuck no. But in this system, without the inflation, your Ponzi scheme collapses.
You know what? Yes. So two things is the first is that I just lost my train of thought. Yeah, so that's what I'm saying, is that it's unlikely you see prices grind down for years because they don't want that to happen. They want to do things.
It's not even that they don't want. They can't.
Yeah.
Have that
so they don't want. So like, you know, so there's likely going to be policy changes to not allow that to happen, to have prices try to increase, right, for the inflation that they want. And then the second thing, what was interesting, just the other day, I saw a clip of Polyev, and he was speaking about, he kind of like really, it's the first politician that I've seen just really outline that. He's like, okay, here's taxes.
He clearly understands money.
Yeah, like
he clearly understands
here's taxes, here's this.
Which will be a shame if he gets into power and then forgets what he said.
Well, I think, and that's exactly what I was going to say.
Breaking down inflation as theft.
As theft. And he's like, here's how it works. Yeah. And they come, you know, and he's like, it's like little people while you're sleeping coming in and taking pennies out of your pocket just enough so you don't notice. And I was like, that's really interesting. And then it made me think, I'm like, well, if he gets into power,
he'll be in a system that needs inflation.
Yeah. So even though he's saying that, so that goes back to the politics side of things. It's just like,
it's a joke.
You can say so much, you know, and you know, but if he understands it, maybe he tries to operate in a different way.
Well, you can also grow GDP in this kind of system that would help people in a productive way, get more, incentivize the private sector in the right ways. I guess like that's one positive he really could do. But when you're in a debt-based money system, he's not really going to get away from the inflation. Yeah. And one way, because we're always asked this, and I kind of see how people will struggle to understand these concepts. And I guess one way I try to explain it is that if you reverse the entire economy back to the first dollar, and this isn't a completely accurate way to explain it because the central banking system back-ended. We had like free banking and we had like multiple banks. You know, you could go and find, when we went to go buy some of our first gold in those stamp stores, you would see a receipt from the Canadian Imperial Bank of Commerce. And that receipt was in exchange for whatever you had on deposit in gold and silver at that bank. You saw it from the Royal Bank as well. And then what happened?
I still have one of those, the bills for one of the CIBC bills.
Yeah.
Their own currency.
Their own currency, because you had stuff on deposit and you got this receipt for what was on deposit. So if you had some gold on deposit, you got this receipt, and that was the receipt, was that currency. And then the Bank of Canada kind of came in here between like the 1910, 1935. Bank of Canada kind of like back-ended and took over the whole system. But by way of example, if you reverse the whole system back to the first dollar, you can think about it this way. Because we're a debt-based money system, when the first dollar entered the economy, it came into the economy with interest owing.
Yeah.
So if that first dollar came into the economy with interest owing, and let's call the interest 10%, and the interest was owing back to the central bank.
Yeah, so it's 10 cents.
So it's 10 cents. But the whole economy only has $1. Yeah. How do you pay off the 10 cents that you owe? So you owe $1.10, but there's only $1 in the economy. The only thing that you can do is borrow again.
10 cents.
You borrow another $1 and the 10 cents. Now there's $2.20 in the economy. But you only have $2 actually in the economy to use, but you owe $2.20. Sorry, you owe $2.20 now back to the central banking system.
Yep.
How do you ever pay it off? You have to borrow more. And this is when we tell everyone it's like a Ponzi. And it's not even that it's like a Ponzi. It is in fact a Ponzi. You can only keep this system going by getting more debt into the system. And it's why things that touch the debt first go up in price the most. It's why real estate goes up the most, because the most debt is created on mortgages and credit lines. So the money touches the real estate market. So things like real estate and contracting and everything associated with the real estate market just kind of explodes in price first, because the money touches the price. The new debt-based money touches these industries first, and it doesn't touch incomes first. So incomes, if you're working in a company, the money has to flow through the economy and flow through a business and eventually get to wages. Mm-hmm. And it's why wages just don't keep up with the monetary expansion. The wages keep up at a slower rate. So your wages grow in this country at whatever, 3-4%, but the monetary system is debasing you at 9%. So you're losing, there's a delta there. You're just losing, compounded every year. Put that into a calculator and look at the difference. After 10 years, it's devastating.
Yeah.
You think you're getting ahead, you're not getting ahead. But that's the way to think about it, is that it's just a debt-based money system that requires inflation. So you can tell Sean, okay, fine, he was right, but the whole system is wrong.
I was just thinking while you were speaking. I guess I wasn't really listening to you. I was thinking about something else. But no, I was.
The regular.
No, I was, but because this is a little bit off topic, but I was listening to you. But I'm this whole tariff thing, because it's changed so much. I haven't really looked into the details of everything that's impacted. I know obviously the auto sector, that's the big one that's impacted. But then I'm thinking about construction costs, and I'm like, I wonder how construction costs could be impacted because what materials and what supplies we're getting from the U.S. and if they are. If the tariffs will be applied to them or not, because that would change the cost of things just in housing.
Well, I know Ruben was saying on one of the spec homes being built in Oakville, one of the builders went to him, and I don't know if this was tariff or just general inflationary costs. He was saying that I think they were building like a $3.5 million house, and that they said they were going to have to lift everything 10% right about now, just because the cost for them to finish it is going through the roof. So I doubt that was direct tariffs too quick, I feel like, and just kind of cost.
Well, you know what? I was when I was getting that surgery done. One of the guys that was there with me. So I don't know him well, but he was set up. I'm like, man, you got a good setup, because he was in like the lounge area and he had his laptop open. Then he had an iPad with the little keyboard. He had another screen going, and I'm like, but you got like you're
what does he
right
do?
Into this. So it's a produce company. 700 employees. So they're doing some volume for 700 employees. They're doing volume into Canada, and he told me a few things. One thing that was interesting, he said, look, a case of tomatoes from I believe he said last year to this year, but anyways, the number went from $5 to $20. Okay, that's not tariff related. He goes, it's $5 to $20. That's like the cost of food. And he goes, now with the tariffs put on top of that, he goes, if you add 25% on that.
So the 5 to 20 was before tariff?
Before tariffs. And then he's like, if you add 20 tariffs on top.
Sorry, did he give you a time frame for that 5 to 20?
Yeah, I'm pretty sure it was last year. I don't know what time, exactly when last year, but it wasn't like a long period of time.
Strawberries?
No, this was tomatoes.
Tomatoes, tomatoes.
Yeah, and then he said strawberries because of the tariffs. So here's what was interesting with strawberries, because they're bringing in a lot of strawberries from California. So he said what we've had to do is we're looking for other suppliers. So he's like, we actually found a supplier from Egypt that we're trying out now. The product seems to be pretty good and the price is right. So they're now looking at.
We're going to fly in our strawberries from Egypt.
That's what he's not doing it yet, but he's like, that's what we're looking at. He goes, it seems like it might be an alternative for them, because they're trying, because the impact from the strawberries coming up from California. But yeah, the first example was tomatoes. Mm-hmm. The case went from 5 to 20. Those were the numbers he told me. That's, so, look, it's some guy that we had surgery together. I was in surgery for a few days up at this hernia clinic. But he seemed like a guy. I talked to him a number of times, and he was definitely like,
I think that's just a sign of the times.
Yeah.
The dollars are losing value. Real things like tomatoes and strawberries are going up in dollar price. They're not changing. It's your purchasing power is changing. You need to protect your purchasing power.
Because they can't print a new tomato. Mm-hmm. Well, not yet. They're trying to. Maybe they can. There seems to be printing
3D printed
somehow.
tomato pretty soon. Yeah, probably.
But it's, they can't do that yet. Mm-hmm. So like, that's why those real things go up in price, right? Mm-hmm.
It's just pretty clear, I guess, like when we saw this happen to our relatives in Croatia, it's just like what happens is people hang on. And eventually it just becomes normal that you use the local currency to do the quick medium of exchange stuff. But anything you're trying to save, you save in anything else.
Yeah.
Whether you're a farmer or a store owner, or you are fortunate enough to have some land or some real estate, nothing is kept in a financial system denominated in a currency that you don't trust.
I'll never forget this one interview that I saw. When did Greece have their kind of economic crisis there?
Like 2012 or something like that?
I forget.
You mean when people were like buying furniture to protect?
Yeah. So I saw someone, they were carrying, it was two people.
Yeah, I remember those pictures. I remember those pictures.
There was an interview with the person, and they were carrying an appliance home.
Was it like a washing machine?
Yeah, it was either a washer or dryer. It was one of those. And they were literally two people carrying it down the street on the sidewalk, carrying it home. And the reason they did that, they're like, well, I know that like the money's going to be worth like a lot less afterwards. So I'm just trying to protect their purchasing power by having that thing. And it was either a washer or a dryer. And I'm like, wow. Like, to think about, at this point we had started researching the money system by then now for a few years. We're kind of trying to understand some of this stuff. And I've just thought, wow, like a country like Greece to me doesn't seem like whatever you want to call like a third world country.
Sure.
So like, it doesn't seem like totally outrageous. And in right now today, at that time, I was like, I'm seeing this happen right before my eyes. Like I didn't understand. I would have never understood that before. And it seemed crazy to me. But that's as eventually that like now that was an extreme case and it got bad for them. But that's kind of what happened. It's kind of nuts.
And right? You can see where just so many people in Canada are going to be blindsided. Like 5 years from now, they're just going to look around and everything will be more expensive, and they won't fully understand why. And the options to gold, Bitcoin, real estate, like just pick your hard asset and start allocating, spread it around.
Real estate's like,
but most people,
everything's down right now. All the stock
markets. But what do you tell people are like, Nick, so well, screw you, man. Like I just haven't paying my bills. Sorry, man. Like I can't even do that. So like I have 2 or 3 kids. I have my expenses. I got my car payment. I'm not sure about my job right now. And you're telling me to get some hard assets. So you can see where a big segment of the population is like, screw you.
Well, yeah, no. And they're right. And they're right, and then you have to focus on paying the bills. Mm-hmm. Like you got to put food on the table for your family, 100%. But if you have savings, and if you're looking to save,
even if you dollar cost average a little bit every month,
yeah, like you said with Addy,
you can do it with real estate. You could do it with silver. You could do it with gold. You could do it with Bitcoin. You could do $10 of Bitcoin a freaking week. You could go to small denominations, right?
We know people that have done that across the board with different things, whether it's with all those things you said, real estate, the precious metals, everything. And now that they're able to look back, 10, 15 years, it's made a huge difference. Big difference. But you're right. If you have absolutely no savings, then then this actually also, it does impact you, but maybe not as much, because the portion that it doesn't impact you is that the savings that you do have aren't getting devalued. Right. So there's still challenges because costs are rising and you got to keep up and you got to worry about your income. So there's still real challenges there, but you don't have to worry about the savings. But if you do have some savings, like even if it's $1,000, $5,000, $10,000 over time that you save up, if you're just leaving it in cash, it's
especially with the global M2 money supply charts that we are seeing right now, it looks like the effect of the increase in liquidity globally that's happened about 2 months ago is going to start hitting hard assets. All the M2 money supply charts that are mapping things like Bitcoin with a lag against M2, like you're going to see hard assets. So it could be Bitcoin, gold, and real estate in for another ramp up over the next 18 months. That's going to catch everybody by surprise. But the M2 money supply charts I'm looking at that have ramped up over the last 60 days, but hard assets have really just kind of been sitting. Gold's been moving, but Bitcoin's just been kind of consolidating here at this price. So if that happens in 6 months, it's going to be another situation where people will be like, oh geez, like how did Bitcoin get to that price? Yeah. But if you look at the M2 money supply global charts now, it's ramped pretty much straight up for the last 60 days.
Yes. The only thing I'm just going to say to all that we were just talking about with Bitcoin, gold, anything, the Addy projects, everything, or any real estate, is that these aren't short-term things. So if you have a small amount of savings and you want to put it into something and you need those savings within like 60, 90 days,
none of this is good.
Markets can be volatile. Yeah. So this is more like long-term
savings.
Because if you're like, well, I need it in 3 months,
this
is going to go
4, 5, 6 years or longer.
You don't want to get, and look, we're not giving financial advice. You do your own research. We're just kind of seeing what that's worked for us.
But look into this stuff.
Yeah. But they, so to that point, with the money supply, here's a chart that I was looking at the other day. The source for the data is someone created the chart off the Federal Reserve data, and it shows that the top 1% of people from 1990. The chart goes from 93 to 2023. So in 2023, the top 1% of earners in the U.S. actually had more wealth than the entire middle class combined. So it flipped in 2003. And the middle class here is defined with the 20th to 80th percentile of income. So people in the 20th to 80th percentile of income, they now have less wealth than the top 1%. And the majority of that, this isn't like that they just have money in bank accounts. This is assets. Mm-hmm. This is like that's what happens. That money supply grows, the people who own assets, their wealth grows. Mm-hmm. And that's how this goes to Jeff Booth's point.
It just centralizes, and the wealth centralizes and 100%. Centralizes further to the top, and it just keeps going. And it's a system that, because it's centralized and the wealth gets centralized, it's rough. Yeah. It's time. You need to know this stuff. You know, it's time.
It's happening.
I'm
right
just trying
in
to
front
think
of
what
your
books.
eyes.
Okay, so just to wrap here, I guess the books that come to mind is Layered Money by Nick Karadza as a great book.
Yeah, I never read that one.
Oh, the audiobook's really good. I think he reads it.
Yeah, I actually think I just added it to my
Layered Money.
collection,
He came out with a new book right now called The Bitcoin Age, but that book goes through the history of banking and money really well. Like Lynn Alden with Broken Money does a great job.
I think because I went through Broken Money, and then at the time when I was looking at Layered Money, I was like, I just did Lynn Alden.
I think it's
so
very simply put. Like he does a really great job of mapping.
Yeah, I should look at it.
So if you read that book, I'd say that gives you a lot of context on like where the money system is. And then if you want a real crazy book to read, if you pick up the book, The Fourth Turning, and just go to, because it's a heavy book, just go to the chapters about the fourth turning, which is a book on economic history and what happens every 80 years or so in the economy. And we're going through a fourth turning right now. If you read the chapters on the fourth turning, even though that book was written like 20 or 25 years ago, something like that, it's really, really insightful. I would say The Fourth Turning, those couple chapters. Layered Money is a great book just that gives you historical context of how we got to this point and why you have to pay attention to all this stuff. Because it's like the ground is like shifting underneath your feet. And if you don't pay attention, time passes and you're caught off guard.
I think, but you know what? I think more people are looking for information. And I think it's why, one of the reasons, I mean, a lot of things happen within your life. Your terms event that's coming up at the time we're recording this is in about a week. And I think it's why, that thing filled up. And this wasn't like a marketing ploy, for some people.
Yeah, it just got jammed quick.
100%
sold
like
out.
We can't, there's a waiting list. And every time that we got a small number of cancellations by the cancellation deadline, those were scooped up from the waiting list same day. Like it's like 100% packed. But it's because that's what that whole event is designed around. It's kind of like, hey guys, let's kind of look at this together. We're bringing speakers that are doing things different ways around that stuff and some of the things that we're looking at. And it's trying to all work together amongst that group of people to all kind of support and help each other, propel past this, because you can. It's not like, oh, everything's crap and you can't, there are ways to propel past this, whether you're young, old, or anything else. So as much as sometimes we're like, it feels like things are kind of screwy, there's opportunity out there.
And the opportunity compounds. Like if you get into real estate, if you get into gold, if you get into some Bitcoin, at first you feel like you're not making any progress.
Yeah, 100%.
But then if you do stick with it for 3 years, 5 years, 7 years, you kind of look back going like, holy shit. Like, so the compounding of the opportunity, and when it starts small, you're like, I'm not really getting ahead in any capacity here. A real estate investor who buys a property, you have no equity when you first buy it.
Yeah.
You can't refinance it.
Small
cash flow is typically tight. But then after, 5 and 10 years, like, holy crap, like that was the best thing I ever did. Bitcoin, usually when you buy it, the day you buy it, it goes down in price.
Yeah.
So then immediately you're like, holy shit.
That was anything I've ever bought.
Yeah, but like you stick with it. It's the same example. You stick with it, and then over time, you get the compound annual growth rate over 5 years, 6 years, 7 years, and it really starts to look beautiful on you. So the opportunity does exist. You just have to have a longer term plan. Like you have to survive short term and then have longer term planned savings,
Yeah. Yeah, and I think that's what we're seeing. That's the difference, and that's kind of cool. I think it's a benefit from us as well, being able to host that type of event and people being there, and us being able to kind of just, have conversations with them to see what other people are doing too. Because when it's the community is all working together towards it helps everyone.
It's funny what's happening. I think now that we're hitting this age and with this much experience in these asset classes, I found myself before getting even though I totally get amped up about stuff all the time, I find myself getting a little bit less amped up about things and more just like, like this is what you have to do. You have to figure this out and, kind of get at it. Whereas before, when we were uncovering the truth of central banking and you realize that debt-based money system was, robbing you through inflation, I did get a lot more up about it. And now it's more just like, hey man, protect yourself in the right ways and you're going to feel good. You're going to be able to think long term. You're going to be able to build some savings, and it just kind of calms you a little bit.
Yeah.
Like you don't feel like you're running on the financial treadmill all the time. Yeah. It is kind of like as time passes, it's like if you do the right things, it's just kind of a little bit calming effect on you.
It does, yeah,
anyway,
for sure.
Not that either of us are very calm.
No.
In general, calm is a relative thing. We're calmer than we used to be. Awesome. Thanks, Nick. Anything else?
No. I think we should leave it at that. We're actually a little bit late. There's a few people waiting for us on the team.
Take care, everyone.